Hello, here we are at International Payments Summit 2013, and with me today is Dermot Turing from Clifford Chance. Now, Dermot, you were talking about the mountain of regulation that is facing the payments industry and the banking industry generally. There was some good news and some bad news in your presentation, I thought. The good news for the payments people was that you think they're having an easier time.
Well, yes, that's true. I think if you look at what banks are actually having to cope with right now, I think most of them would probably say that EMIR, which is the regulation on OTC derivatives and clearing, and AIFMD, which is the directive about hedge funds and private equity and various other things, they would say those are more burdensome for them at the moment, and they're more immediate. Some of the payments related stuff's a bit further down the track. SEPA has got a February 2014 date around it. You can kind of leave it to next year. So I think banks are probably getting more stressed about these other very, very big projects that they've got going on at the minute. And the payment stuff, yes, there's lots of it, but it's kind of smaller and it's kind of further away.
And the interesting thing that I picked up from your presentation was that it's some of the other things that are more nebulous on the horizon. For instance, on competition and interchange, some of the government notions about competition in the payments infrastructure, which are likely to have unintended consequences.
Yes, I think there's a little bit of a sort of philosophical divide on this. I mean, the policymakers are very, very keen for banks to innovate and to create new products for consumers and so forth. And I think, you know, that's something that the industry is broadly supportive of. But there's a tension there because every time banks try and get together to collaborate to provide a standardized way of doing things or to interoperate or to create new models for working together, there's a real risk now that they are clobbered by the competition authorities. And the reason for that is that the European Commission has introduced something called the horizontal guidelines, came into force a couple of years ago. And what those guidelines say is that if anybody has a legitimate interest in the development of a standard, they are entitled to a voice at the table right from the very start. And that makes it very difficult because banks are used to getting together and working out how to do things. It's not that they want to do things necessarily in a closed and anti-competitive way, but it's very difficult to even begin anything because you don't actually know who to invite to share in the standardization process. And so I think banks are finding that very challenging at the moment, and even to an extent it's stifling innovation because, you know, sometimes the penalties for getting the competition analysis wrong can be very severe. So, you know, I'm not surprised that they're feeling a bit cautious. They've had their fingers burnt a couple of times in the last couple of years. So, I think it's a tough environment at the moment.
And your advice to them was to sort of stand up and push back a bit to the regulators.
Yes, I think so. I mean, one of the things that I think banks haven't made enough noise about is that, particularly in the transaction banking and the payments space, what they do is actually socially useful. It's not the kind of casino banking that caused the crisis or the LIBOR business that caused the scandals that we've seen in the papers or for the last year or so. What they do, frankly, it may be more mundane, it may be less sexy, but on the whole it's socially useful. It's the kind of thing that the world can't do without. And so I would suggest to the banks that they should be going to the regulators and the policy formers and perhaps educating them a little bit about what they do and why it's useful and why therefore a bit of a break on things like capital and liquidity rules might actually be beneficial for everybody.
Mm-hmm. And you warned, well not warned, but you discussed in wrapping up, there are 5 sort of hot targets that people perhaps aren't thinking about while they're thinking about SEPA too much.
Oh, yes, I would say, I mean, there's a new directive on cybersecurity I think people should be thinking about. There's going to be a regulation on cards, which may also have some pricing regulation in it. There's PSD2, we mustn't forget that. And then perhaps a sort of slightly wild card, there's the Recovery and Resolution Directive, which I think for network banks, for the global banks, is going to be very, very challenging in how they fit their businesses within the framework required by that. That's going to be very difficult.
And in some extent, your conclusion, if people don't get this right and don't engage regulators, and regulators go ahead with some of their, and policymakers particularly, go ahead with some of their plans, you painted a bleak picture of what might happen.
Well, I mean, my fear, let's hope I've got this wrong, but my fear is that if it becomes very expensive and very complicated in terms of structural reorganisation and liquidity and capital requirements and so forth, people who are active in providing these kinds of socially useful services will decide to exit the industry or sell to a larger competitor. And that seems to me to lead to a rather unpleasant environment where, yes, the services will still continue to be provided, but by a diminishing pool of global players. And we all know that it's not entirely satisfactory to have an environment where there aren't enough competitors.
So if laws designed to protect consumers and create competition have exactly the opposite effect.
Yeah, I mean, and that would be a terrible shame. So that's the thing that, you know, they've got to work a bit harder to get right.
Okay, Dermot, well, let's hope you're wrong about that.
So do I, yes.
Thank you very much.
Thank you.